Hello and welcome to another Market Matters weekly update. I'm James Gerrish and today I'm joined by Charlie Aiken, Chief Investment Officer at AIM. Thanks for joining us, Charlie.
Good morning, James. Good to be here.
Thank you. I want to start today just by looking at the bigger picture themes in the market. You know, we've had US bond yields are up pretty strongly last night. There's a bit of disconnect between what the market is positioning around rates and what the Fed is telling us. What's your take on it?
Yeah, no, we tend to actually be on the side of the Fed here. We think that the bond market's very, very crowded on the long side. They've taken the view that the Fed won't be able to raise rates on their trajectory on the dot plots. We think the truth lies somewhere in between, but probably we favour the Fed more. You got a surprise from the ECB last night, and you saw that it only took a little bit of movement in German 10-year bonds for all bond yields globally to rise. So, look, we're positioned in our portfolio for rising bond yields and rising financials, and we think that'll probably be the scenario in the second half of this year.
Yeah, we saw it play out last night, financials best sector over in the US, on crowded trade. So obviously the US dollar filters into this, but I want to touch more on the NASDAQ now. The US tech sector has been on a scream over the last 12 months. So the index up by about 30% financial year to date. It's now the most crowded trade in the US. At the end of 2016, early 2017, the US dollar was the most crowded trade. We've seen that decline about 7% year to date, sorry, in 2017. What's your take on the NASDAQ? A bubble? How do you describe it?
Well, the most overowned small group of stocks I can ever remember. They're big stocks, but I can never remember over ownership like this. I mean, I think the narrow leadership of the US market this year has been concerning, and we're starting to see that slightly unravel, I think. You know, I worry about those big five tech stocks. I think they're now completely overowned. I think they're overpriced, led by Apple. I think you're starting to see that unwind. When you see stocks like Apple in low volatility ETFs, value ETFs, momentum ETFs, growth ETFs, the biggest stock in the S&P 500, the biggest stock in the Dow, the biggest stock in the NASDAQ, you're like...
It's a stock for all weather, mate.
Well, it's a stock for everything. Apple added before last night $240 billion in market cap this year. Its earnings haven't changed. To me, that is not going to last. So we've recently sold out of all tech stocks in America, with the exception of one Chinese-related one, and we think a pullback is on there. And I think the correction, actually, James, could be quite violent there. When you've got that much momentum money sitting there, I would not be surprised to see a 15% pullback in the NASDAQ, but rotation to other sectors.
Yeah, so how does that play into... So last night the NASDAQ was off 1.6, Dow was off 0.5%, S&P a bit more. How does that play into those areas? Does money go out of the US and into other parts of the
Yeah, I think
globe?
you'll see money leave US tech firstly, because it's been so dominant, but it's just basic profit taking after huge gains, right? So then we've seen rotation to Europe almost on a daily basis. Flows into Europe are quite strong, so we think that'll continue. Two best performing markets in the world. If you take the NASDAQ out of the US this year, the US actually hasn't done much. You know, so we actually think there's other sectors in the US that'll do well, financials, some industrial cyclicals, some domestic facing stocks. And in Europe, we like financials and domestic facing stocks in Europe and in the UK. So we don't think markets fall apart on this. You'll just see some violent rotation like you did around when President Trump was elected. Remember, the big losers when Trump was elected was tech.
Yeah.
And financials did well and cyclicals did well. I think that trades back on in the second half of this year, but we favour Hong Kong and the Eurozone over America under pretty much all circumstances.
So you talked about different areas benefiting. Material stocks. Now we're dominated by materials here in Australia, as well as financials, obviously. You look at a number of measures. Material stocks are cheap relative to the S&P 500. There was a chart that we put out a couple of days ago that they're the cheapest relative to the S&P in history.
Yep.
What's your take there? Is that we're having a good day on the market today. Fortescue up 4% or so.
Yeah.
Iron ore was up 5% last night. Is that a contrarian play?
Buy in gloom. I think it is time to buy in gloom in the BHP, Rio's, Fortescue's, or at least cover your shorts.
There's plenty of gloom out there.
I think the short trade's over. Look, I'd also agree with Elliott Advisors' approach to BHP. I think there is greater value in BHP spinning off its oil assets and things like that. So, if I bought one of them, which we're thinking about at the moment, I'd probably buy BHP in London at a 15% discount to Australia, but also in British pounds. Now, if that works, it means BHP will go up here. But look, material stocks were part of the reflation trade in the second half of last year. If we're right and bond yields go up and tech goes down, material stocks will go up. They will be part of the reflation trade like they were last night, which actually started in Asia yesterday with the Dalian iron ore futures mysteriously rising 6%. So yeah, I think they do fit in. I would think that the starting point in the BHP's Rio Fortescue's is okay down here. I'd rather buy iron ore at $55 than $100. And yeah, I think it fits in. So look, we'll be looking to selectively add to some material stocks over the next little while, because it's part of what we broadly believe in.
So what about US dollar? So obviously US dollar is a big issue globally. You know, if US bond yields are going higher, how does the dollar? We're down 7% year to date. Is the dollar going lower or higher? And how does that feed into your thinking?
It is tricky. We've been bearish on the US dollar and had exposure to the Australian dollar back in our global fund. But to me, look, you look at last night, the dollar fall, a lot of it's about the euro rallying and the pound rallying. So the euro and the pound represent about half of the dollar index. The rest is Japanese yen and other things. So it was actually not really to do with the US dollar. It was actually to do with the numerator rallying, which was the euro and the GBP. But look, where we've got our money, we don't own really any US dollars at the moment. We do own pounds, we do own euros. So that's probably a view that we think the US dollar could fall a little bit more, or actually more that those currencies could do a little bit better. Aussie dollar, it's a complete conundrum because, I know it's important to all of us, but domestic consumer-facing activity is definitely weakening. Definitely on the East Coast. Building materials, retail, everything. You can tell it's slowing down. We've all got too much debt and here we are. So, but, the US dollar's been falling and commodity prices may be bottoming. So,
but the Aussie dollar's a cork in the ocean, right? It's being dictated by external factors.
It is,
largely.
really, the US dollar. Look, I think the US dollar's got a little bit further downside, but I wouldn't be surprised to see it bouncing at some stage in the last quarter of this year. But really, it comes down to, if you saw last night, German bond yields rose faster than US bond yields, and so the euro did better than the US dollar. But I'll tell you what, James, it is a big salad bowl for the second half of this year. There's plenty of moving parts. And I'll tell you one thing I'm absolutely sure of, that this low point in this really quiet period of volatility, that is over. That is over.
The Dow was off nearly 100 points last night. The biggest move in 6 weeks.
Yeah, I know.
Which is pretty astonishing.
It was the biggest bond move, like the biggest 10-year bond move since March, and it was only 6 basis points. So I would say to your readers and viewers that just be prepared for some action here. Doesn't mean markets fall apart, but there could be some very violent rotation, similar to what we saw, after the Trump election.
So what's your take on? I talk to a lot of fund managers. A lot of fund managers are cautious. They've got high cash levels. We've had high cash levels going into May. We're now we're sitting on around 10% cash at the moment. What's your take? It concerns me when everyone's cautious. I think the market grinds up when everyone's cautious and everyone's holding high cash. What's your thoughts?
Well,
how are you positioned?
As a fund manager, you sound smarter if you're cautious. That's how it works. I remember when I was a broker, if you were cautious, everyone thought, wise sage. But look, there's seasonal times to be cautious, as you guys point out many times. I think that's right. That seasonal point is sort of playing out right now, and maybe time to put some cash to work. Look, with the global mandate, we can always find something to put money to work in. We are 100% long at the moment globally, but we're also about 30% short. We're finding things we can short. So we're about 70% net long. But we are fully invested on the long side because we've got European financials, Chinese financials, American financials, a couple of other specific things in Australia. And look, we can find things to invest in. I do not think markets broadly fall apart when everyone's cautious or has protection or has cash. But there can be big rotations. I'm more of a believer that we're going to watch tech unfold here a little bit and other things do really well, which could include Australian materials, could include financials. Banks in Australia could do reasonably well just on foreign banks doing well.
Insurance stocks?
Correct. This could get really interesting, I reckon.
Well, thanks for joining us, Charlie. We'll be back next week for another weekly update.